Well, hi everyone. This is your welcome to week 6 video, and I thought we'd do a little quick recap as usual of week 5 and then move into a discussion of what we're going to be talking about in week 6. Class is progressing along very quickly, and so I'm glad everyone's up to date on assignments. I will get your week 5 written assignments turned around and back to you as quickly as I can. I should have those back to you hopefully by the very beginning of the week. So what I'd like to do is just very briefly do a real quick recap of week 5. As you know, in week 5, we looked at government intervention in a variety of different policy areas, primarily focusing on government intervention in education and in welfare and in the area of social insurance. Our focus really was upon education, and that was your written assignment for this week, and looking at some of the alternative delivery mechanisms that exist in the education policy area other than public provision and production of education. And so two of the major alternative delivery mechanisms we looked at is we looked at the use of vouchers, and we also looked at the use of charter schools. Now, as you know from the videos that you watched and from our discussion of vouchers, one of the major issues with education vouchers is the idea of portability. And voucher programs that tend to be relatively successful are those that have good portability mechanisms built into them. Clearly, if you don't have portability in a voucher system, then your parents are left with only the schools that are currently in their jurisdiction or in their community, and they really don't have the choice that you really like to build in with a voucher system. Now, the problem with portability, and I made this note on my feedback on some of the papers from this week, is that for portability to actually really work, we need to kind of believe in Charles Thibault and his very famous theory of the mobile consumer. And so as Charles Thibault tells us in his mobile consumer thesis, what you have is you have different jurisdictions that provide different bundles of goods and services for their citizens. Citizens can then vote with their feet. And so if a citizen prefers the bundle of goods and services from school district A, they'll enroll their children in school district A. If they prefer what school district B is offering, they'll enroll their children in school district B. It's basically what you have with the mobile consumer thesis. You have the antecedents for what we know today as public choice theory, that you allow people to vote with their feet. The problem with that thesis, as we all know, is that there are some inherent limitations that people have in their ability to vote with their feet. That there are job requirements, there are family requirements, perhaps they don't have the financial wherewithal to be able to vote with their feet and move to a district or a school that better meets what they feel their child's wants, needs, and desires are. And so not everyone has an equal opportunity to truly be Thibaultian in their selection of schools. So what oftentimes happens is that those individuals and those families that have the financial wherewithal, those are the ones who can take advantage of the portability of a voucher system. But for those parents who do not have the financial wherewithal, they're oftentimes stuck in their community. And so what you end up having is when you do have portability in your voucher system, you are encouraging oftentimes your more affluent residents to go to other schools and perhaps to move closer to those schools and move out of your jurisdiction. This is what we refer to as the donut hole effect. And I'm sure you're all familiar with some of the financial issues that major metropolitan areas, especially in the Rust Belt, had throughout the 1970s and the 1980s, where a lot of affluent residents were voting with their feet, and they were moving out of the central city and moving into secondary and tertiary suburban areas, primarily for the education and for the schools. And so you hollowed out your central city, and what you ended up with is you had your less affluent residents who stayed within the central city. Well, those less affluent residents obviously don't have the ability to contribute as much to the tax revenue that the city or the school district will be receiving, while at the same time, those are the same residents who will place increasing demands upon city and school district services. So you have a paradox there. You have a situation where the government is losing tax revenue at the same time that its expenditures are increasing because of all these additional demands that are being placed upon the city and the school district by less affluent families. So sometimes the whole portability thing doesn't work unless you really buy into a Tebowian type of economic assumption of this public choice type of orientation. And then we also talked about charter schools, and many of you talked about charter schools in your paper. Again, charter schools, the impact of a charter school on a public school system will depend upon the type of charter school that you are talking about, whether it is a fiscally independent or a fiscally dependent charter. Fiscally independent charters tend to have more of an impact financially on public school districts than would a fiscally dependent charter. In fact, the way in which state law is written, fiscally dependent charter schools may actually have a positive impact on the revenue stream of those public school districts that charter those schools. And the reason for that is that the state legislature has built an incentive into the funding formula to encourage charter schools. And so if it's fiscally dependent, public schools may actually benefit financially from chartering these fiscally dependent charter schools within their boundaries. But here's a really strange quirk in the California state law that was just only recently remedied. But for years, the way in which a charter school law was written, a public school district could charter a school outside of its boundaries. Now, it sounds kind of strange, but it's true that a public school system could decide, well, we're going to get additional money if we charter this school because of the way state law is written, but we can charter this school within the jurisdiction of another school district. So it's actually located outside of the boundaries of the district that's issuing that charter. And that was completely allowable and was permitted under state law for many, many years. And we saw some public school districts actually benefit from doing that. Now, it sounds strange from us, from our understanding of intergovernmental relations and the principles of fiscal correspondence and all those things we've come to expect in a federal system, that you could have one local government locating a school in another local government's jurisdiction without that other local government having a say in the process. But that's exactly the way in which the law was written. And so that happened on many occasions. And so you could be a school district that would have a charter school open up within your jurisdiction that you did not approve of and that you have absolutely no control over. So it's kind of a strange situation. It has recently been remedied by the state legislature. So public school districts may not charter schools outside of their jurisdiction anymore. So that problem has been fixed. But it was a really vexing problem for a lot of school districts for many, many years. So the impact that a charter school will have on the delivery of public education, it really does depend upon the type of charter school and how that charter is actually written. We spent a little bit of time looking at the role of government in the provision and production of welfare policies. I think I had mentioned to you before, and it was discussed in the book, the major change that we had in welfare policy in the mid-1990s, the Personal Responsibility and Work Opportunity Reconciliation Act, just a very long name for what came to be known as welfare reform. And with welfare reform in the mid-1990s, we had a monumental shift where we shifted our focus away from assistance to needy families, and we moved more toward this quote-unquote new type of grant known as a TAMF, or Temporary Assistance to Needy Family Grant. It wasn't a new idea in that TAMF grants are block grants, and we'll talk a lot more about categorical versus block grants when we get to that week of the class and talk about intergovernmental relations. But TANF grants are block grants, which provide a lot more flexibility and discretion to recipient governments, being state governments. So state governments had a lot more flexibility as a result of welfare reform in terms of how they reduced their welfare rolls. Now, the primary goal of the program was obviously to move people from welfare to work. And some states were very, very successful doing that. Some states were not quite as successful. And just really quickly, not to digress, but one example of a state that was extremely successful with these new welfare grants was the state of North Dakota. And you might think, well, why North Dakota? It seems like kind of a red herring that they would be the one that would be the most successful. And the reason why they were the most successful is in the mid-1990s is where you had the discovery of a lot of oil in North Dakota. And so you had a lot of firms going into North Dakota pumping oil. They had to hire people. And it really got to a situation where they didn't have enough people to hire in North Dakota. So they had to try and lure people into North Dakota to work for in these oil mining types, oil drilling types of facilities. And so it was very easy for North Dakota to move people from welfare to work because they had more jobs available in North Dakota than they really had people to fill those jobs. But one of the artifacts of this welfare reform was a heightened role for public-private partnerships. And so we started to see more and more public-private partnerships after the mid-1990s in welfare policy than we had ever seen before. So again, kind of suggesting there's more of a role for the private sector in what was traditionally seen as being very much of a publicly dominated type of policy area. And then we spent a very little bit of time this week as well looking at social insurance and talking about things like Social Security and focusing primarily on the issue of the insolvency of Social Security. And as you know, we have had Blue Ribbon Commission on top of Blue Ribbon Commission trying to come up with plans that make Social Security as solvent as possible. You have some reports saying Social Security will be insolvent within the next 1 to 2 years, some saying it'll be 10 years, some saying it'll be 30 years. But there have been a lot of calls in Congress to privatize several different aspects in Social Security. Once you start privatizing Social Security, then you're talking about limiting the role of government intervention, and that role has been something that has been with us since the creation of Social Security back in the Roosevelt era. But again, we just kind of looked at how government intervention works in several different policy areas. And in week 5, you looked at education, you looked at welfare policy, and you looked at social insurance policy. Looking ahead for this week, in week 6, we are going to really drill down to the issue of taxation. And we're really going to look at the government's role in taxation and really have an eye on some of the negative externalities of taxation. Now, as we know, government derives a large amount of its revenue from taxes, whether it be income taxes like we see at the federal level, or sales taxes like we see at the state and local level, property taxes like we see primarily at the local level. Governments get a lot of their revenue from taxation. Now, less revenue from taxation than they used to get before, especially here in California. If you look at pre-Proposition 13 in 1978 versus post-Proposition 13, you will see a pretty pronounced decline in the percentage of revenue generated from the property tax in the wake of Proposition 13. And actually, that was one of the subjects of my dissertation many, many years ago, where I looked at, from a school district perspective, the impact that tax limits like Proposition 13 had on the ability of local school districts to generate property tax revenue. And one of the things I found is that even though Proposition 13 was passed by the voters in 1978, you really didn't see a precipitous decline in the amount of property taxes generated by local school districts until 2 or 3 years later. So the real hit to local school districts didn't really happen until about 1981. And the reason for that is that once Proposition 13 was passed by the voters, the state legislature decided to step in and backfill some of that lost property tax revenue and give some revenue back to the local school districts to kind of make up for the loss that they are going to experience as a result of Prop 13. It kind of cushioned the blow a little bit, if you will. But the revenue diversity, the revenue portfolio of local governments here in California look a lot different after 1978 and Proposition 13. We will spend some time this week talking about the evaluative criteria for taxation. And when we talk about the evaluative criteria for taxation, we are looking at the types of issues that we have to consider when we as a government decide to impose taxes on our citizens. And there are several different evaluative criteria to take into consideration. Some of the major ones that we will look at this week: burden distribution, as I like to call it, where we ask the question, who pays the tax? So should this tax be paid by primarily upper income individuals? Should it be the burden, should that be borne by lower income individuals? Should it be a flat tax where you try and spread the burden out? Who really should pay the tax? And that's what we call burden distribution. Here in California, as you probably know, the California tax system is very antiquated and very inefficient, in that our tax system really doesn't focus on services at all. And as you know, our economy nationwide, not just here in California, but across the entire country, has really migrated from a manufacturing-based economy to a service-based economy. The problem is that our tax structures have not kept up with that. And there's always been very much of an aversion among taxpayers and among states as well to levy taxes on services, because it gets a lot messier whenever you try and tax services. Traditionally, the basis on which we've applied taxation is what's known in the tax world as a situs basis, S-I-T-U-S, a situs basis. And a situs basis for taxation means that you will tax based upon where that tax incidence occurs. So a perfect example of that is a property tax. So you will assess the property tax based upon the assessed valuation of a piece of property. So a piece of real property, you will assess the valuation of that real property, and you will then apply a tax rate to that assessed valuation. But it's very situs-based. It's based upon that parcel of property. Give you another example, sales taxes traditionally have been situs-based as well, in that it depends upon where you purchase the good, how much of a tax you'll pay. Because as we know, we have a local option sales tax here in the state of California. So one county may have a higher sales tax rate than another county. So where you purchase the good can have an impact upon your tax liability. Now, obviously, for very large purchases like a car, you can't go to a rural county in California that has a lower sales tax rate and expect to pay that sales tax rate on that car and then bring it back to, say, LA County and avoid that extra LA sales tax. It doesn't work that way. That you'll be charged the tax on that car based upon where you reside. But again, that's a situs-based type of tax. So that's traditionally how we have taxed individuals. The problem, again, is that our economy is moving more toward a service-based economy, and our tax system just really hasn't kept up with that. The other major problem a lot of economists will tell you with the California tax system is that it is very heavily leveraged on upper income wage earners. So here in California, upwards of about 80% of the tax revenue is coming from about the top 1% of wage earners in California. The problem with that is that it makes our tax revenue collection very susceptible to ups and downs in the economy and ups and downs in the stock market. And so as the value of stocks decline and those returns decline, then those folks in the top 1% are going to have less revenue coming in and less money coming in, which will then equate to less tax revenue coming into state coffers. So whenever you heavily leverage yourself on a very small segment of your taxpayer population, you are very susceptible to volatility in the economy. But that's basically how we have for years structured our tax system here in California, where we have tried to distribute the burden so that most of the burden falls upon upper income wage earners and much less of the burden falls upon lower income individuals. Why have we done that? We have done that primarily for the purpose of progressivity, to try and create what we refer to as a progressive type of tax. Now, as discussed in the textbook, a progressive tax is a tax where those who have more of an ability to pay will pay a higher percentage in taxation than those with less of an ability to pay. And the very clear example of that is our graduated income tax system, both at the federal as well as at the state level. So at the federal level, we have a truncated system of marginal tax brackets. And so if you're in the top tax bracket, you may end up paying 35 to 39% of your adjusted gross income in taxation. If you are at the lower end of the income scale, you may not end up paying any in taxes, or you may pay less than 10% in taxes for your income tax at the federal level. So that's progressivity, trying to make sure that people who have less of an ability to pay will pay less in taxation. And the whole idea of that goes back to disposable income, that those at the lower levels of the income strata will have less disposable income than those at the upper level. And by disposable income, again, we introduced that concept in a previous discussion. By that, we basically mean once you have purchased all the staples of life, this is the amount of money that you then have left over. That's what we refer to as your disposable income. So for the sake of fairness, we try and make our tax systems as progressive as possible, and that's why we have a graduated marginal income tax system at the federal as well as at the state level. What makes it marginal is that if you're in the highest tax bracket, you don't pay 39% or 35% on your entire income. So up to a certain dollar amount, you will pay 10%. Then for every dollar above that, you might move up to 15%. Then for every dollar above that threshold, you move up to 20%, and so on and so on. And so it's meant to try and shield our taxpayers from having excessive tax liabilities, while at the same time creating the most progressive system possible. So in terms of progressivity, your graduated income tax structure, if done correctly, can certainly be a progressive tax structure. Now, the problem you run into, and we'll see this a little bit more in week 7, where you get into a discussion of personal versus corporate income taxes, but the problem that you run into is when you have such a complicated system of deductions and exemptions and credits. And when you have all these quote-unquote loopholes in deductions, exemptions, and credits, then you sometimes reduce the progressivity of your tax, because typically people at upper income levels are probably the ones who have a better ability to utilize all these deductions and exemptions and credits. And as you'll see in week 7, there's a distinct difference between what is a deduction, what is an exemption, and what is a credit. And I won't get into it now, just to say that deductions and exemptions are not as powerful as tax credits. Deductions and exemptions are subtracted from your adjusted gross income before you calculate your tax liability. So make no mistake, deductions and exemptions are powerful in that they will reduce your overall tax liability, but they'll only do it through reducing your adjusted gross income, because they are taken off before you calculate your tax liability. Now, tax credits are much more powerful, because tax credits come directly off of your calculated tax liability. So if you do your taxes, you calculate your adjusted gross income, taking off your deductions and your exemptions, you go to your tax table and you say, okay, I owe the IRS $15,000. However, I have an earned income tax credit of, say, $5,000. That $5,000 is subtracted directly from your $15,000 liability, thus reducing your liability to $10,000. So tax credits are much more powerful tools than what we have with deductions and exemptions. But one thing to be very careful about with tax credits is that there are a lot of deductions that masquerade as credits. It's very common for Congress to pass a credit, quote unquote credit, that is really just a deduction. So to determine whether it's a deduction or a credit, look at where it is applied in the system of calculating, the process of calculating your tax liability. If it's applied before your tax liability is calculated, it's really a deduction. If it's applied after you calculate your tax liability, then it is a true tax credit. So some examples of two true tax credits: the Earned Income Tax Credit, EITC, variations of the Child Tax Credit. Those are what we consider to be true tax credits. And just a little piece of advice: if you do your own taxes, the IRS has some red flags that they look for in conducting audits. And one of the major red flags the IRS looks for is if a taxpayer claimed the Earned Income Tax Credit. The Earned Income Tax Credit is meant for individuals who are working, who are employed full-time, but are making below a certain income level. So all too often we have some taxpayers who misread the instructions and they will claim the Earned Income Tax Credit even though their adjusted gross income is above that income threshold. But that's just an example of a pure tax credit. So we try and make our tax systems as progressive as possible. And like I said, the graduated income tax system tends to be a relatively progressive type of tax if done correctly. The average effective rate for a taxpayer in America is about 13 to 14%. So even though some of their income may be taxed at the 35% level, overall, after deductions, exemptions, and credits, the average taxpayer usually is paying about a 13% effective tax rate. Now, some folks are higher than that, some folks are lower than that, and unfortunately, with all the loopholes that we have in our tax system, sometimes you'll see extremely wealthy individuals who end up with an effective tax rate of 0. And it's just because they are able to play the system and use the deductions, credits, and exemptions to their advantage. An example of a very regressive type of tax is traditionally the sales tax, something that is consumption-based. And the reason for that is that those individuals with less disposable income are spending a higher percentage of their income on the staples of life. And so if you do not exempt the staples of life from your consumption-based sales tax, so if you're not exempting things like food, things like pharmaceutical medications, prescription medications, then you can end up having a very regressive type of sales tax. That's why we tend to have these things called commodity exemptions, where we will exempt food if it's not consumed within a restaurant. Perhaps certain types of food will be exempt. As I said, prescription medications will be exempt from sales taxation. In some states, clothing up to a certain nominal amount will also be exempt from taxation. All those commodity-based exemptions are meant to try and make the sales tax more progressive in nature, even though it tends to be, by its very nature, a very regressive type of tax. So you have to look at the progressivity or the regressivity of the tax and the impact that it has on different segments of your society. Administrative ease, how collectible is the tax? Some taxes are very, very collectible, some are not so collectible. The old adage when it comes to the collectability of a tax is the more active the taxpayer is in remitting the tax owed, the less collectible that tax tends to be. So taxpayer active taxes tend to be less collectible than taxpayer passive taxes. So an example of a taxpayer active type of tax could be something such as property taxes if they are not rolled into escrow. So with your property taxes, if you own a home, sometimes you will either be required to or you'll choose to roll your property taxes into escrow, which then allows your property taxes to become part of your monthly payment. So your monthly mortgage payment will be a little bit bigger because a percentage of that monthly mortgage payment goes toward prepaying your property taxes. That's escrowing your property taxes. If you do that, it becomes very taxpayer passive because it's just rolled into your monthly payment. You don't really see it. You don't really feel it. just gets paid on a monthly basis. However, for some other homeowners, they will not escrow their taxes. They won't roll their taxes in. And so twice a year, they will get this bill in the mail from the county assessor's office saying, here is the amount of property tax that you owe. And those bills come out twice per year, and they tend to be very large bills. Well, it's very taxpayer active because you then have to take the initiative of writing the check and sending the check off in order to pay your property taxes. So when we tend to see defaults on property tax liabilities, it tends to be when the taxes are not rolled into the monthly payment, tends to be when it's a very taxpayer active rather than a taxpayer passive type of collection mechanism. Take a look at something like a sales tax. A sales tax is very taxpayer passive. It's rolled into the price of the good. So you go into a store, you purchase something, you pay your state sales tax and you pay your county sales tax, all rolled into the price of the good. And then the vendor collects that tax and then remits that tax to the taxation authority. The taxation authority usually provides an indirect, about a 1% administrative payback to the vendor to compensate them for collecting this tax on the state or local government's behalf. So since with the sales tax, you are collecting the tax from a very small number of vendors as compared to a large number of individual taxpayers, it becomes a very taxpayer passive tax. Tends to be very easy then to collect the sales tax. Now I'll give you one more example, not to belabor the point too much, but since California tends to have some relatively high tax rates in some regards, if you go online and you purchase a good that does not have a sales tax attached to it, so you're a resident of California and you go online and you purchase something from a vendor that's located in Maine and they don't charge a sales tax to you, you're not completely free of paying tax on that good. Because when you purchase that from the company in Maine, you are then having it delivered to California and you are then consuming that good within California. When you bring a good into the state of California and consume it within the California state boundaries, you are then subject to what's referred to as the use tax. Use taxes are used by governments when they're not able to use their sales tax. So if you bring something into California, you are technically required to report that to the state, typically in your income tax filings, report the value of that good to the state, and then remit tax based upon the value of that good that you are consuming within California. Now, that's a very taxpayer active type of tax. And I'm not going to ask people how often people actually pay it, because I did a study about probably 15 years ago now looking at 5 different states and the collectability of their use taxes. And I found out that the collection rates for most states for their use taxes was less than 0.001%. Because people just don't do it. They don't know they have to do it, and they just simply don't do it. So the more taxpayer active it is, the less likely it is you're going to be able to collect that tax. But your ability to collect the tax is oftentimes dependent upon 2 different variables: tax capacity and tax effort. Tax capacity speaks to the ability of the jurisdiction to generate the tax revenue. So for instance, with the property tax, you would look at the assessed value of properties within the jurisdiction, and that assessed value, the value of property that's subject to the property tax, would then be an indicator of the tax capacity of that government. So some governments will have a very large tax capacity if they have a lot of very high value properties in their jurisdiction. Other jurisdictions may have much less of a tax capacity. And then the second variable is tax effort, the amount of effort that the government puts in to collecting the tax that is owed. Property taxes tend to have about a 97% collection rate. They tend to be relatively collectible types of taxes. In fact, for a lot of local governments, when they go out to get a bond rating, they are expected to show that they are collecting at least 97% of the levy owed to them, or else they're going to take a hit in their credit rating. So it's a very, very high standard, 97% tax collection. That's an example of tax effort. How well does the jurisdiction collect the tax that's owed to it? Obviously, to collect an adequate amount of revenue, you need to have both tax capacity as well as a very healthy level of tax effort. Economic efficiency. This is a big one, and I would argue this is probably the biggest evaluative criteria that has the largest impact upon us in this class. And that's why we're going to spend a lot of time this week looking at the economic efficiency of taxes and the potential distortion that a form of tax may have on the economy. And we have mentioned this before in previous videos, but it really hits us hard this week, and it really becomes the main topic we're looking at this week. Hence the reason why in your discussion board post for this week, where you're going to do a multimedia discussion board like you've done in the past, the topic of your discussion will be different types of taxes and the potential distortion that you receive from those types of taxes. So when we talk about economic efficiency and distortion, we're asking the question, how does the tax affect economic activity? Because we really know it's a two-way street. Taxes can affect economic activity. Economic activity can then have an impact upon tax revenue. So you got to remember both sides of the street. But whenever we impose a new tax or whenever we increase a tax, there is a price effect. The price will go up. It will increase the price point. As prices go up, that may then have an impact upon consumer demand based upon the elasticity of demand for that good. And we've talked about elasticity before. With elasticity, we're asking the question, if the price goes up, does it have an impact upon how much of that good someone will consume and someone will demand? Some goods are very price elastic. Some goods are very price inelastic. So an example of a price inelastic good traditionally is motor fuels, gasoline. That's why the motor fuels excise tax has been a source of taxation that a lot of governments have used to then take the revenue and put it back into highway construction and reconstruction. There's a federal excise, motor fuels excise tax. There's a California motor fuels excise tax. That money is then supposed to, doesn't always, but it's supposed to then go into a highway trust fund, and then the highway trust fund funds all the renovations and reconstruction and modernization that we do on our roads and our highways. Now, that usually provides a pretty significant amount of revenue and a relatively stable amount of revenue because demand for gasoline tends to be relatively inelastic. People need to get back and forth to work. They need to put gas in their cars. They're going to pay for the gas. In fact, now the demand in terms of the automobile market is that there's a heightened demand for SUVs and for pickup trucks as opposed to compact vehicles. And that's why we saw just recently GM laying off, what was it, 12 to 16,000 employees, closing 5 or 6 plants that produce compact cars so that they can focus more attention on producing SUVs and trucks. People are always going to demand gasoline. And so it tends to be a relatively stable source of revenue because it's relatively price inelastic. However, there are other goods that are much more elastic in nature. So that if you increase the price to a cost prohibitive level, then you're going to see a decline in demand. This is essentially that Laffer curve that you're also familiar with, that kind of bell-shaped curve almost, where as you increase your tax rate, you will get more and more tax revenue up until you hit a critical point. And when you hit that point of critical mass, where the price gets too high and becomes cost prohibitive, then as you continue to increase your tax rate, you're actually going to see a decline in revenue because of the decline in demand and consumption of that good. So typically when we are looking at taxes, we are concerned about all the criteria. We're concerned about who pays the burden. We're concerned about fairness and progressivity. We're concerned about ease of collection and how much revenue we're able to generate. But where we really focus a lot of our attention is on economic efficiency and how much potential distortion there is from this tax on the economy. And this really gets at the heart of everything we've done in this class up to this point in time. Whenever government intervenes, the question becomes, is there a greater value for government intervention than the private sector resources we are displacing by that government intervention? And it's the same type of idea here. By imposing this tax or increasing this tax, government is intervening. And by intervening, does that intervention by definition mean that there are going to be some consumption side or some production side losses as a result of that increase in taxation? So as you work on your discussion post this week and your multimedia presentation, that's the issue that you're going to be dealing with. And what I would like you to do is look at different types of taxation and talk about the potential distortion effects that you can have from those different types of taxation and just how efficient those are in terms of the economy, and which types of tax revenue have less of a distortion effect, which have more of a distortion effect, and why. So I know I've gone on for a while and made this a little longer than I usually like to do, but I just want to kind of introduce some of these week 6 concepts to you and to, again, really focus you in on this whole idea of the type of tax and how economically efficient that tax is in terms of how much or how little it distorts economic activity. So again, as I said, I will finish up your week 5 papers as quickly as I can and get those back to you. Up to this point in time, the written assignments have all been very good. I haven't had any major issues with any of them. I try and provide you with a good deal of feedback there in the feedback box to kind of engage you in more of a discussion of some of the content of the papers. You probably noticed up to this point in time, my comments are really much more content-based than they are format-based. Because what I really want you to get out of this class is much more the content than really the APA format or things such as that. And so I tend to be very content focused with a lot of my comments. I hope that's been useful for you. Well, I hope everyone has a really great week. And if you have any questions, as always, feel free to shoot me an email. I am back in town for my conference now, and so I should be readily available to answer any questions you may have. So have a great week, and I will talk to you soon.